How many real bull markets has India actually had in the last 36 years? Well, most market experts would probably say 4. But veteran investor and GQ Phoenix Ray founder Shankar Sharma disagrees. He says India has had only 1.6 real wealth generating bull markets. And once you adjust for inflation, accounting changes, and liquidity, the gap between those two answers tells us almost everything about India's equity story: what was real, what was manufactured, and what was mythology. That gap also has serious implications for foreign institutional investors and retail flows. Let's understand how in markets this week. The first great rally came in the early 1990s. The Sensex exploded, overnight fortunes were made. The last rate became a national obsession. But Sharma argues this was never a real bull market. It was a narrow, liquidity-driven surge funded by money diverted from public sector banks into a handful of insider-controlled stocks. When Harshad Mehta's fraud was exposed, it crashed just as fast. Sharma calls it a tiny rigged wave. Then came the dot-com era. Tech stocks exploded globally and India participated too. But corporate earnings from 1996 to 2000 remained flat to declining across most sectors. Only tech performed, and the boom lasted barely 18 months. When the global bubble burst, Indian markets corrected sharply. So this wasn't a bull market, it was a sector bubble wearing one's clothes. Now this is the period Sharma considers India's sole genuine bull market. Nearly everything aligned. GDP growth approached 9%, corporate earnings surged, fiscal conditions stayed stable, and large caps and small caps rallied together. The rupee even strengthened from 47 to 39 against the dollar, amplifying returns for foreign investors who evaluate India in dollar terms rather than rupees. So it was a broad-based economic expansion translating directly into earnings growth across sectors. Then came COVID. Markets crashed in March 2020. What followed looked like another historic bull run. But Sharma argues this cycle behaved very differently from 2003 to 2008 because much of the earnings expansion came from margins, tax changes, and accounting shifts, not necessarily from equally strong demand growth. A major corporate tax cut in FY20 boosted earnings per share or EPS. Also, the shift from standalone to consolidated reporting inflated reported earnings further, so valuations appeared cheaper than they actually were. There was another difference too. In the 2003-2008 cycle, entering the market slightly early or slightly late still produced exceptional returns. But post-COVID, returns were intensely timing sensitive. Those who entered at the exact bottom vastly outperformed those who entered even a month later. Now that's the hallmark of a narrower, liquidity-driven rally. This is where the FII story becomes important. Indian retail investors continue investing aggressively through SIPs, but FIIs have remained far more selective. Because global investors look at dollar returns, taxes, currency depreciation, valuations, and long-term earnings quality. And once those adjustments are made, India's returns may not appear as extraordinary as headline numbers suggest. Over the last 10 to 12 years, the Nifty has delivered roughly 10% pre-tax in rupee terms. In dollar terms, that halves. So Sharma's message for what lies ahead is direct. Making money from here means going stock by stock, sector by sector, trench by trench. The age of easy market-wide returns may already be behind us. Follow Business Standard for more stories.